So, let's tackle the big question on everyone's mind. Is this AI boom just the dot-com bubble all over again? Or is something fundamentally different happening this time? You look at the headlines, you feel the hype. It feels a lot like 1999. In this analysis, we're going to cut right through that noise. We'll look at the hard data and see if history's just repeating itself, or if we are actually at the very beginning of a new industrial revolution.
So, is it a bubble? Well, if you measure by emotion alone, then yeah, it sure feels like it. The temperature is incredibly high, just like it was back then. But when we dig into the numbers, a completely different story starts to emerge. Let's explore why the foundation of this AI era is built on something much, much more solid.
All right, let's start where everyone else does when they scream bubble, valuation multiples. The big question is, are today's AI companies just wildly overvalued? Let's see what the numbers have to say.
Okay, this side-by-side comparison is incredibly telling. Let's take the forward price-to-earnings ratio, which is basically what the market is willing to pay today for profits it expects in the future. At the peak of the dot-com frenzy, the market was paying around 60 times future earnings. Today, we're hovering in the 26 to 31 range. Now, that's still high, don't get me wrong, but it's not in the same universe. Then you look at price to sales. Cisco, the absolute titan of that era, hit a mind-boggling 200 times its sales. Compare that to NVIDIA, the titan of our era, trading at around 50 times. So yes, the valuations are steep, but they are nowhere near the speculative stratosphere we saw in 2000.
And here's the absolute critical point. Today's high valuations are being driven by some of the most explosive, real-world earnings growth we've ever seen in corporate history. It's a direct relationship. This is the complete opposite of the dot-com era, where so many valuations were built on promises, on hopes, and on a metric as fuzzy as capturing eyeballs. So, big valuations are one piece of the puzzle, but profitability, now that's what separates a real, sustainable business from just a speculative bet. So let's compare the two eras on this front. And wow, the difference here is just night and day. Back at the dot-com peak, an incredible 86% of tech companies that were going public were actually losing money. Think about that. Today, the companies leading the AI charge aren't just a little bit profitable, they are financial giants, some of the most efficient, cash-generating machines the world has ever seen.
The margins tell this story even more clearly. Your average dot-com company had an operating margin around 12%. Not bad, but not amazing. Today's AI leaders, they're consistently operating at more than double that, clearing 27%. And then you have an outlier like NVIDIA, which is posting margins over 50%. I mean, that's a level of profitability that is almost unheard of for a company of that size. It's truly in a class of its own. Okay, but it would be a huge mistake to say there are no warning signs, because there's one area where the dot-com comparison is uncomfortably accurate, and that's in the world of early-stage AI startups. This is where the risk is really concentrated. Right now, we're seeing startups with no product, no revenue, and maybe a dozen employees getting valued in the billions of dollars. The valuation per employee metric is off the charts, and it feels exactly like the speculative craziness of 1999, where a great pitch deck was often more valuable than a great business. But here's the crucial distinction, and this is so important. The market structure is completely different. The dot-com market was like an inverted pyramid, built on a wobbly base of unprofitable companies. Today's market is a proper pyramid, anchored by those incredibly profitable giants we just talked about. The speculative froth is all contained in a little bubble at the very top. So if that startup layer pops, it's not going to bring the whole system down with it.
And that brings us to what I think is the single biggest, most important difference between then and now, where all the money is actually going. This is a fundamental shift from bits to atoms, from algorithms to actual industry.
The dot-com boom was all about spending money on digital, intangible assets. Companies blowing billions on Super Bowl ads, on branding, on marketing, just trying to get attention. The AI boom, on the other hand, is a capital spend on hard, physical assets. We're talking trillions of dollars being poured into tangible, industrial-scale stuff, massive data centers, specialized chips, and the power grids needed to light it all up.
Let's be really clear. This isn't just a software upgrade. What we are witnessing is one of the largest and fastest industrial buildouts in human history. The planned spending on AI infrastructure is already rocketing past $1 trillion a year. We are physically rewiring the real-world economy to power the digital one. And if you look at this from a historical perspective, this cycle could have a long, long way to go.
Right now, all this AI infrastructure spending accounts for about 1% of GDP. But if you look at previous buildouts like the railroads or the telecom networks, they peaked at somewhere between 2 and 5% of GDP. That suggests this current wave of spending could potentially double or more before it's all said and done.
Now, when you're undertaking a physical construction project this massive, you run into completely different problems than you do in a software boom. In fact, the fundamental bottleneck we face today is the exact opposite of what killed the dot-com dream. You see, the dot-com bust was ultimately caused by a glut of supply. We built way too much fiber optic cable, miles and miles of dark fiber that nobody was using. Today, our primary problem is a shortage of supply. There is an absolutely insatiable demand for computing power, and more importantly, for the electricity to run it. We are hitting what people are now calling the power wall. There simply isn't enough juice to go around. The sheer cost of entry into this new industrial game is just astronomical. We're talking up to $55 billion to build a single gigawatt of AI-ready data center capacity. And this isn't just about putting servers in a big room. It involves incredibly complex, specialized cooling and power delivery systems. That immense price tag acts as a natural brake, preventing the kind of reckless, cheap overbuilding we saw in the dot-com era. And here's the other catch. This infrastructure isn't something you build once and you're done. The speed of innovation in hardware creates this relentless treadmill risk. A cutting-edge chip today is basically obsolete in 2 or 3 years, which means you have to rip and replace it. This forces companies into a cycle of continuous, massive reinvestment just to keep up. It's a game that only companies with incredibly strong and consistent cash flow can afford to play. So to wrap all of this up, let's use 2 simple analogies that I think really capture the fundamental shift between these 2 moments in technology. Think of the dot-com era as the blueprint phase. We were drawing up the plans for our digital world, figuring out e-commerce, social networks, search engines. This AI era, we're done with the blueprints. Now, we are building the physical factories that actually manufacture intelligence at an industrial scale. Or think of it this way. The dot-com boom created millions of digital retail shops. The AI boom requires the construction of massive, industrial-grade power plants just to keep those new factories running. And this quote just nails it. The whole game is changing. The competitive edge is shifting from who has the best code to who can secure the most wattage. Leadership in AI is going to be defined not just by algorithms, but by access to cheap, reliable, and abundant energy. So, in the end, the question we should be asking isn't, is this a bubble, but rather, what kind of revolution is this? And all the evidence is pointing in one direction. The future isn't just being built in code, it's being built with concrete, with copper, and with massive cooling systems. It seems the next decade is going to belong to those who can master the physics of power just as well as they master the logic of programming. Thanks for tuning in.